control foreign company. If you're an expat living in Italy or considering moving here, understanding the principle of the control foreign company, or CFC if you want, is critical, especially if you have international businesses over there. The CFC rules are designed to prevent tax avoidance by individuals or more in general companies shifting income to low tax jurisdictions. So let's break this down, okay? What is the control foreign company principles about? A controlled foreign corporation or company is a business entity registered and conducting business operations outside of the country of residence of its controlling owners. So in Italy, and in most jurisdictions, by the way, the purpose of the CFC rules is to ensure that income earned in the low or almost zero tax jurisdiction is subject to taxation in the taxpayer's country of residence. So, for instance, let's consider Marco, an Italian tax resident. He owns 60% of a corporation incorporated in Malta, okay, where corporate taxes are definitely lower compared to the Italian rates. According to the Italian CFC rules, the income generated by Marco's company in Malta could be taxed in Italy unless he proves that this branch carries out really existing economic activities in Malta. Each country all around the world has specific criteria for identifying a CFC, but the general principles are pretty consistent and common. Number one, ownership threshold. In Italy, a foreign corporation qualifies as CFC if an Italian resident directly or not directly owns at least 50% of the shares of the company. Number two, taxation thresholds. A foreign corporation is deemed a CFC if the effective tax rate in the foreign jurisdiction is less than 50% of the tax rate it would face under the Italian jurisdiction. So let's dive into an example to clarify. Sofia, she is an expat living in Italy and she owns 70% of a foreign company based in the Cayman Islands, which have an effective tax rate of 0%. So what is the scenario without the CFC rules application? The Cayman Island company generates, let's say, 1 million in profits annually. Sofia pays no corporate tax in the Cayman. And previously, the income have allowed Sofia to avoid Italian taxation on the company's income. Now, what happens if we apply the CFC rules? Under the CFC rules or laws, Sofia must report the profits from the Cayman Island in the Italian tax return. So assuming an Italian corporate tax is, let's say, a flat 24%, Sofia she could face an impressive liability of 240,000 on the company's profits unless she can prove that the income was definitely carried out and mainly carried out in the Cayman Island. Your goal is to manage CFC risks before moving to Italy. CFC laws can create significant tax liabilities, but there are ways to manage these risks effectively. I would start with demonstrate economic activity, real economic activity. Prove that your foreign corporation, your foreign branch, has a legitimate presence, such as an office, employees, and active operations in the foreign jurisdiction. For example, Marco, from the earlier example, he can avoid the CFC classification in his branch in Malta if, for example, he calls employees out, maintains an office, and generates income from active operation in the foreign country. Then I would recommend leverage tax treaties. I never get rid of this. Many countries, including Italy on top, have tax treaties that allow, for the avoidance of dual taxation. So proper structuring and documentation are the key to benefit from these treaties. And why not? If you can, think about restructuring the ownership. Reducing ownership below the CFC threshold can definitely help mitigate the impact of these rules. So for example, Sofia, by the previous case, might sell a portion of her shares to a non-Italian resident to reduce her ownership below the 50% and thereby avoiding the CFC classification. Italian tax residents currently with interest in a foreign corporation or company must comply with the strict reporting requirements. I'm talking about the wealth tax, RW, and this includes filing detailed disclosures about the foreign company's activities, income, and yes, financial statements. Let's meet Luca, okay? He's an Italian resident. He owns 55% of a company in Dubai. He's required to file the RW form to disclose the foreign assets, report and pay taxes on the share of the company in Dubai and on the income generated in Dubai, even though it hasn't been distributed yet. So failing to comply can result in penalties, ranging from substantial fines to even criminal charges. So the common question I hear over and over is why this CFC rule matter this much. The ultimate goal, or the primary goal of the CFC rules, is to prevent tax evasion by discouraging the use of tax havens. However, they also at the same time create challenges for legitimate businesses with international operations. So expats in Italy must carefully navigate these rules to avoid unexpected tax liabilities and audits first thing first. So for example, let's consider Emma, a UK national and an Italian tax resident, and she owns 51% of a Hong Kong-based company. Despite the Hong Kong clear and favorable tax regime, Emma must now account or report everything under the Italian CFC rules. So her Hong Kong company's profits are now taxed in Italy, unless she can demonstrate that the company operates as a genuine business in Hong Kong. Ignoring these CFC rules or not knowing about the CFC rules can lead to consequences right away. Let's meet another one, Sofia, who failed, in this case, to declare her Cayman Island company's income. What happened? The Italian tax authorities discovered the omission during an audit. So now Sofia faced a kick-ass bill of $720,000, 3 years of unpaid taxes of $240,000 each, plus penalties, plus interest. And yes, this experience serves as a tale about impersonal compliance. Control foreign company, controlling foreign corporation rules are a real task, due diligence you have to play with in the international tax system. Ensuring for the taxpayers about to move to Italy cannot avoid their obligation by just, shifting income to a low tax jurisdiction or simply leaving your business in the country of origin. For expats in Italy, understanding and complying with these rules is critical. At the same time, by leveraging expert advice, demonstrating real business activity carried out, and maintaining transparent reporting and up-to-date reporting, you can navigate CFC rules successfully and focus on building your international ventures with no problems. Yes, even in Italy.
At Studio Rigo, we provide world-class tax and financial guidance for expats and international professionals in Italy. We don't just help you stay compliant. We craft strategic tax solutions tailored to high-level individuals who demand precision and expertise. If you are serious about optimizing your tax position, visit our website or connect with us on social media. We work with those who value excellence, and we look forward to assisting you. Thank you for watching. See you in the next video.